Nice to have you back. Good to have you first this time of year. Ohioans know, Americans know that our economy fundamentally is not a fair playing field. Instead, we have a David and Goliath economy where the largest corporations use their power to funnel all the gains in the economy to the top, aided and abetted by too many people in this room. Corporations squeeze every last penny from Americans' pocketbooks and workers' paychecks. They don't even try to hide it anymore. The biggest corporations are charging more for less. Americans are frustrated. No, actually, Americans are pissed off. They have fewer and fewer choices. Those choices cost more and more. Keeping prices down is part of the Fed's mandate, but as many of us have made clear, the Fed's main tool to combat inflation, raising interest rates, does nothing to address the biggest causes of rising prices right now: corporate greed. Keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing costs. Housing prices and rents continue to go up. It's no surprise that since the Fed began raising rates, the amount of income families need to qualify for a mortgage has nearly doubled. Homeownership has long been a bedrock of our middle class, but today fewer and fewer middle class families can afford to buy a home. Higher interest rates are making our country's housing supply shortage worse, not better. We need more housing construction of all types. Higher rates lead to the opposite, and particularly make it harder for multifamily construction to work financially. Higher interest rates make borrowing more expensive for working families, whether it's for a mortgage or a car or anything else. Most people don't have the luxury of paying for everything in cash. And for the millions of Americans feeling their budgets stretched by higher prices, taking on credit card debt to pay for groceries and other essentials has become an option of last resort. But as more people struggle to pay down their debts, credit card interest rates are reaching all-time highs. Last month, Director Chopra testified in front of this committee and explicitly stated that credit card issuers are charging higher rates far beyond what they need to cover their costs. Corporate greed rearing its head again. Banks are making record profits at the expense of cash-strapped Americans. Every month that the Fed keeps rates high, Mr. Chair, it costs Americans money by making it more expensive to buy a house and to borrow money. Higher borrowing costs stifle future economic growth, leading to fewer homes being built, leading to businesses making fewer investments in the economy, and eventually, if the Fed doesn't stop, leading to workers losing their jobs. As they set economic policy, I urge the Fed to weigh these trade-offs and remember whose jobs and futures are at stake. It's why I've worked with my colleagues to hold corporations accountable and will continue to do that. For instance, we fought to cap insulin prices for senior citizens. We'll continue to fight to extend this price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other bank regulators issued a proposal to update bank capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards. They're critical for the economy. It's our way of making sure that if Wall Street bets go poorly, which they often do, investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another dangerous piece of the Wall Street business model that makes our banking system less safe is incentive-based compensation. This compensation model rewards risky behavior that enriches Wall Street executives in the short term, but makes banks more likely to fail. We saw the results of that model in 2008. We saw it again last year with the failure of Silicon Valley Bank and Signature. Other regulators have moved forward with a proposal to rein in these reckless incentives, But the rule, Mr. Chair, can't move forward without your and the Fed's moving on it. This rule is long overdue. The Fed must join this statutorily required effort as soon as possible. The Fed also has the important job of reviewing mergers and acquisitions between and among banks. Over the last several decades, we've seen the largest banks grow into massive, literally trillion-dollar companies, while thousands of small banks in rural communities in Northwest and Southeast Ohio, in small towns in those communities, in those areas, and all across America have disappeared. Consumers have lost trusted local banks. Small businesses have lost longtime reliable banking partners. Regulators like the Fed have the crucial job of guarding against mergers that reduce or eliminate competition and lead to bank closures or layoffs. I recently sent comment letters to the OCC and the FDIC on their current efforts. I expect the Fed to take the proper steps to ensure that its merger review process is robust and that it protects consumers and communities. Finally, Mr. Chair, you must ensure the Fed has high ethical standards. Fed officials should never again be able to profit from their positions by using confidential plans about Fed monetary policy and emergency programs to pad their investment portfolios. The board's latest update to its trading rules is simply not good enough. It still fails to establish the clear penalties needed for Federal Reserve officials who make investments in violation of the public trust. A rule with no consequences is really not much of a rule at all. The American people need to be able to trust that the Federal Reserve works for them in a time of deep cynicism that people have about the federal government overall. The American people need to know that officials aren't abusing their positions for personal gain. As chair, you have an important role to play to make sure our economy works for everyone, not just for Wall Street. The Fed's regional banks must do their part to hear from people and other stakeholders in their 12 districts to understand their needs. I look forward to hearing today how the Fed will balance its dual mandate, how it will protect Americans' money, how it will foster an economy that upholds the dignity of work. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chair Powell, for being with us this morning. Welcome and welcome back. Joe Biden broke this economy, and it's been very difficult to fix it. That's the bottom line. I want to start with the end in mind. Joe Biden broke our economy, and it is very difficult for anyone to fix it. Everyday families are struggling to put food on the table. Real wage growth is being eaten away by rising prices and runaway inflation. Think about the fact that for 52 consecutive weeks under Joe Biden, wages were eclipsed by inflation for 52 consecutive paychecks. I remember back in December 2020, in South Carolina, gas was $1.99 per gallon. Today, it's still $3.19 per gallon, a 50% increase in just a few years. So it's devastating to the average American family, particularly families like the one I grew up in, a single-parent household mired in poverty. When you see your gas prices up 50%, your food up 30%, your cost of keeping your house cool or warm up 25%, it's not a challenge. It's not unfortunate. It's an absolute crisis. And too many households in America today are living paycheck to paycheck, and they fear the challenges that are coming our way, the headwinds brought to us by the Biden administration. Those headwinds, of course, are seen through the prism of inflation. Inflation hasn't been this high since the Jimmy Carter years, and that devastation is being felt and measured in households by too much month at the end of the money. And that devastation is real for the vast majority of Americans. And the pointing finger, I tell you what, whether it's the Biden administration throwing the Fed under the bus or any other way they can deflect from the real problem. I've seen it, committee hearing after committee hearing after committee hearing. My friends on the left want to point their fingers at anyone other than the real culprits at 1600 Pennsylvania Avenue. The progressive wish list, spending projects, and out-of-control regulations of this administration continues to eat away at American paychecks. And they continue to blame, whether it's shrinkflation, greedflation, skipflation. They're looking for someone to blame except for Bidenflation. The devastation of Joe Biden's economic policy continues to impact everyday Americans. The American people see through the facades and they want real solutions. It doesn't take a PhD economist to understand what the average American is experiencing under this administration. When President Biden and my Democratic colleagues pump trillions of dollars into our economy, those dollars increase the demand and pushes prices higher. It's that simple. The American people see and feel it every single time. And they see it, as I said earlier, the grocery stores, the gas stations, at the doctor's office. It's just undeniable the impact that this is happening. Just last week, we celebrated the birth of our country, the birth of this notion of freedom and liberty. But American families got slapped with the most expensive July 4th on record, with a cookout this year costing, on average, 30% more than it did just a few years ago. I call that hogwash. What's worse is that this administration doesn't want to learn a lesson in economics. Instead of reducing the push for more spending and more regulation, they only simply double down. Let's take, for example, the tens of billions of dollars of student loan forgiveness. Constant new plans to forgive more money, regardless of the constitutionality of their decisions. So it's important to ask, who are these billions of dollars of forgiveness actually benefiting? Well, the answer is simple. This forgiveness scheme will result in debt relief for 750,000 individuals from households with an average income of $300,000 or more. And just don't forget the fact that the average American family has a household income around $74,000. So what we're doing with this unconstitutional student loan forgiveness is actually asking the median household of $74,000 per household to bear the burden of forgiving debt for students who live in households of over $300,000. And the actual cost of this, somewhere between $870 billion and $1.4 trillion. So why do I have to even ask the question? Why do we continue to punish American families struggling paycheck to paycheck with a new scheme to relieve households over $300,000 of student loan debt? Well, the answer is pretty simple. Politics. It's one way to buy vote after vote after vote for November's election. It's just hard to imagine. So while I appreciate your measured words outlining the Fed's work to cool inflation, I think it's past time we all recognize what is truly going on. Political pandering from the left. I strongly believe that our economy cannot handle any more of this wasteful spending. And if you disagree, I would love to hear your thoughts on that. But it's not just spending policies that stifle growth, it's also overregulation. And I can't think of a better example of overregulation than parking more capital on the sidelines through Basel III endgame. That proposal itself would cost millions of Americans their chance to own a home, start a small business, and have access to the credit and the capital necessary to make their American dreams come true. For those who are actually watching this hearing today on C-SPAN, Basel III capital requirements are like taking your star quarterback, Dak Prescott, and telling him to sit on the sidelines because he just might get injured during the season. It's just plain ridiculous. But these proposed capital requirements would just do that, forcing more money to the sidelines of the greatest economy on the planet and out of the hands of first-time home buyers, business owners, and folks trying to achieve the American dream. The stakes are high, and that is why we have to get this right. You've heard me say this a number of times, but it bears repeating. We need transparency in your rulemaking process, as this normal proposal lacks any form of clear justification. Chairman Powell, it is essential that you, your fellow governors, and the other agencies join in this rulemaking, follow the law, do the homework, and then let the public check the work. And that's why I believe that it is absolutely necessary to have a complete re-proposal of Basel III Endgame. Give the stakeholders an opportunity to take a look at it and then recalibrate what is necessary going forward. Any increases in capital that are not quantitatively justified harm the American people who need it most. Our farmers, home buyers, small business owners need and deserve access to credit. Therefore, I'll repeat it one more time. You need to restore confidence in this rulemaking process, pull the existing proposal, and have a complete restart. And then, when the data has been analyzed and is available for the public scrutiny, reissue an appropriate proposed rule following the requirements of the APA. I look forward to your opening statement and having a chance to have a conversation afterwards.
Thanks, Senator Scott. Mr. Chair, welcome. Thank you for your service and for your testimony today. Please proceed.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs-to-workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy. Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%, and by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign-type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because they'll be passed on likely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that the labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed, and because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time, but now the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point, we would hope. That might be a wish rather than a direction.
I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Thank you. Just 2 weeks ago, the Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on reading the actual letter and intent of the law and following it carefully. This is a strong institutional value that we have. Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will, of course, follow the law as the Supreme Court as the Supreme Court has read it, because that's their job.
Well, thank you, and I concur with compliance with the law. But when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal. That can be seen certainly as good news. Some reports say it could be finalized as soon as August. Others say you are circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes, that has been our practice. We don't see a reason to deviate from that practice. It seems to be consistent with past practice and with the Administrative Procedure Act. So that's very much what we think. And we're working through that question with the FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that we will. We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process, appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be, when we do reach agreement with the other agencies fully, that we would publish the proposed changes, and also the quantitative impact survey, and also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time, and then having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place, before you actually put out the revised proposal. Quite a bit of work. So it will take some time, and then we would put it out, and then there would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point, as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly in curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful. In the thousand-plus pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before the pandemic. Certainly, the pandemic has created new distortions, and monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity in the housing sector. But I would also say the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis, so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say, still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics? Because I think it's, from my perspective at least, I think it's limiting the opportunity for expansion, it's limiting the opportunity for entrepreneurs, business startups, And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
These are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce.
Okay.
And so more of it is better. But as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I, and political influence, I don't think, helps with monetary policy in the country. And so give me your perspective, at least, on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially all advanced economies have adopted a policy of central bank and operational independence, and that just means that we make our decisions, we're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions as part of my job, and the story for the last 2 years has been just how exceptional the performance of the U.S. economy has been, and that's not a secret. Clearly the U.S. economy has performed very well compared to sort of our advanced economy colleagues.
Is there any country in the world with a central bank, any advanced economy that's performing better?
Better as a central bank?
Any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for coming in again and visiting with us. I just want to focus on two specific items, and I'm going to start with the Basel III endgame discussion. I think Senator Scott did an excellent job of kind of laying out the concerns that many of us have had with it. I would like to go back into just one particular issue, which I think a lot of folks out there that follow this, and I know it's technical in nature, but let me just ask a specific question, and you can kind of pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every risk type outlined in the proposal. Since there will be significant changes, do you believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
For those people who are not familiar with, that's the legal test that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would legally require a reproposal. And I don't want to make the legal judgment. I will just say again, from my standpoint, my view and strongly held view of some of my colleagues on the board is that it will be appropriate for us to put out the changes again for a period of comment, just because it's the right thing to do. It's what we would do typically in a situation where there are, material changes to a proposal.
Do you feel that you have a consensus in the board to allow that to move forward in terms of an additional comment period?
Yes, but of course we have to get the FDIC and the OCC. We're in discussions with them to work on something that would meet that need. And we have to get their agreement too.
Assuming, it sounds like that's the path that you would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III endgame proposal probably into next year before it would become anything of a final determination?
I think that may be right. You know, it's that's something like that could be right. Yeah. I mean, it's you can't be. It's hard to be precise. You know, we would put it out. It takes some time to write this stuff up. Then you put it out for comment. Then you get the comments. Then you read the comments. Then you write the final rule. You know, beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side of the equation on inflation is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because one of the starting points that we talk about is when this administration took office and what happens with supply side issues at that time. And as I work my way through this, I just want to share the concern that I've got. And then I recognize you don't want to be political in it, but I want to lay this out. And then I want to talk about what you can control and what you can't control with regard to making changes on inflation through the processes that you have. When President Biden took office, gasoline prices, since President Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on, but you understand what I'm saying is energy has increased substantially. And I think one of the reasons for this has been additional demand as we've come out of a pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges that we've seen in this country?
That's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element. And we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate.
Just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
It is supply.
It is both. Yeah,
Thank
for
you.
sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment has risen by 0.5 percentage point over the past year. The number of job openings has dropped almost 50%. The hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good-paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates on the labor market?
So I completely agree with your characterization. The latest data do show that we've had considerable cooling in the labor market, and we're very much aware that we have two-sided risks now, as I mentioned earlier, and we're determined to balance those as best we can. We want to see more good inflation data, and we also want to continue to see a strong labor market. And those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job, and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. We will say that over and over and over again. I think you understand that. Housing, higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you 3 quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single-family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments. So in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the Synapse bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees one of Synapse's former partner banks, Evolve Bank and Trust. As a regulator, it's your job to make sure that banks protect the people whom they serve. What's the Fed doing to help customers who felt the impact by the Synapse collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse, or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action before this all happened. We did an inspection or looked at Evolve, and we hit them with an enforcement action around these very risk management issues, again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible. We will continue to talk to you about that. We will watch. We will let you know we're watching. The Fed needs to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that led to the bank's failure. You either watched or had reports of when those bank CEOs testified in front of this committee. The report, the incentive-based compensation that led to the bank's failure, I mentioned, it said that SVB managers, quote, had a financial incentive to focus on short-term profit over sound risk management. That's what a number of us, Senator Smith, Senator Butler, Senator Warner and I have said over and over, that that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you know, you read the reports at the outrage of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman. Thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What time
not just
frame?
Well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with, any other banking agencies having a concern with releasing it? Or is it just a matter of
Not at
pro
all.
forma? Okay.
No, it's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that, and your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a postmortem on some of the decisions that were made when we had consistently high inflation, we had consistently high unemployment, what lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there were significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to, each one of these things is different in its own way. We try to learn the lessons of history, though.
Do you agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing is the Fed considers making broad and material changes to the Basel III proposal. Back on that one. Can I urge you not to overlook the second-order issues important to FBOs and certain regionals to ensure that the banks are not unduly influenced? If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say we're very conscious of the comments across the spectrum: foreign banks, domestic banks, small, medium-sized banks. Everyone's going to get heard carefully as part of this process. That is our obligation.
Okay. And I think in response to Senator Round's question, you did indicate there's probably, because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important, because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again, coming this late in the questioning. I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get, unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, before we think about additional regulations, and we do need in some cases, I think the discount window is an underused tool, was one of the original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, making sure any new regulatory structure, how it intersects with existing regulatory structure in terms of market risk, credit risk. And I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of those standards are under review and what your thinking is.
Yeah, and I think that actually connects to the Silicon Valley Bank questions as well, where I think there seems to be a need to update assumptions about liquidity. And that's a separate proposal that we're also working on. And, very important. I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case, if you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things, I guess, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals. So whether it comes from you guys or from folks listening, how we think about this new internet-driven world. And frankly, I think some of the irresponsible behavior by some of the folks that were major depositors in SVB who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand-new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report and also in light of just the SVB and the few of the other failures we saw last year?
Vice Chair Barr who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC in that Thursday through Sunday, and I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but there were pretty scary 3 or 4 days there, and it did seem like the process, I don't know completely how you get fully ahead of that, but I firmly believe that there should have been a clearer early warning system and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thanks, Senator Warner. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
Our unemployment rate is rising, is it not?
Yes, it is, although the labor market is still strong.
Our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
Mm-hmm. And I was looking at the recent jobs numbers. I know you've glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and it's narrowing.
It tells you that government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure and hospitality jobs have slowed to almost a trickle.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, three-quarters of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't they?
In this report, in this single report, I don't know that healthcare is really government spending. I mean, that's something people are consuming.
Where do you think these hospitals get their money?
They may get it, but I mean, people are not. The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you. I mean, here's my point. We talk a lot about expectations in terms of inflation. How if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we cede to them. Most of our economy in America is consumer driven, is it not?
Yes.
Unlike, say, China, which is manufacturing driven.
Very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch
You don't want to answer that
a sentence with that word in it.
Yeah. Yeah. I mean, we can pretty this up I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off today. And one can marshal a persuasive argument that, well, you should, compared to Europe or compared to China, compared to Canada. But feelings are feelings. People don't feel good about this economy. And it's primarily because of inflation. Let me use my final 30 seconds to ask you. I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
I hate to comment on something the chairman was speaking about.
Oh, go ahead.
Well, so I will just say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand. And we use our tools to work on the demand side of that and bring it back into line with supply.
I got 2 seconds. So when are you going to lower interest rates?
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on kind of the line of questioning that Senator Tester was on a bit ago. He was talking about how the U.S. economy has been outperforming other advanced economies around the world in terms of growth rates, in terms of unemployment, in terms of inflation, getting inflation under control, though I think we obviously can all agree that we're not, at least from my perspective, we're not done yet, and we don't want to rest on our laurels, but I'm wondering if you could share what you think that we have learned from this experience. What have we done right, and why is it that we are doing better than some of the other advanced economies in the world?
I think that it's down to the fundamental strengths of our economy. So, as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give, and that I would give, is it's down to, more flexible labor markets. They, in the pandemic, people they stayed in their existing jobs. In the United States, we had people changing jobs at record levels, and that's the kind of thing that adds to productivity and it contributes to rising living standards, going back to school, getting skills, and things like that. Another one is our financial sector. We don't just have banks. We have a highly developed ecosystem of financing sources that will fund early stage investments. Banks are really not set up to do that. They're prudentially regulated. And so those are some of the things. I think we just have these natural strengths as an innovative, more flexible economy. We can grow faster.
I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't expect you to make this case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy, survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about, I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space. We know that has been under strain the last several years. The sector has remained largely stable, but we are hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these smaller institutions might find it a little harder to deal with this. So could you discuss this with us? Could you tell us a little bit about how you see this risk and particularly whether this poses some additional risk that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure?
Yes, so this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the large banks can manage this problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration in commercial real estate. And, we're in touch with those banks. The supervisors and regulators are in touch with those banks and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of, and again, it'll be with us for some time.
Thank you. I think so much about the importance of these small regional community banks in small towns, even big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thanks, Senator Smith. Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you. And I am going to make you do the whole last 5 minutes, since I'm the last one for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future, and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those 3 topics. Somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are pushed into a rental market, driving rental costs up. So there is sort of trickle-down impact here. A recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead-in to just ask the question, how do you envision or view the interest rates of today and the monetary balance and policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people is to restore price stability so that as we benefited from, I graduated from college in 1975, near the end of the big inflation period. So during most of my adult life, inflation has just been not a factor. And that means, stable interest rates, relatively low interest rates. We want to get back to that. And that is what the Fed's job is that we're not supposed to look at the housing market as separate from the overall economy. In the meantime, though, there's no question that higher interest rates are making it harder to buy homes in the short term. But in the longer term, this is the best thing particularly for younger people who are not yet in the housing market.
Let me sort of in line with that community, constituency, population, and definitely aligned with the concerns of my state that's actually facing some severe climate impacts, just as we speak with wildfires and our colleagues and fellow Americans in Texas and the impact of the hurricane. I wanted to pull in your sort of thoughts about the Fed pilot on the climate scenario exercise. In May, the Fed conducted a pilot climate scenario exercise and asked the 6 largest U.S. banks to examine their balance sheets and how it would be effective if a large hurricane hit the Northeast. They reported facing data gaps on property characteristics, their counterparties and insurance coverage. How does the Federal Reserve intend to invest in expanding the modeling resources for banks that are implementing climate-related financial disclosures?
So we haven't made any decisions on what to do with that information or whether to repeat that exercise. To your point, it was really a learning exercise. How are banks thinking about this, and how are they modeling it, and how does it work really? It's a very, very challenging thing to model. And so that was really the nature of this exercise. In terms of disclosures, we don't really have that's not really our job. That's really the SEC. So, but we don't have a big job on climate. But what it really is to make sure that the institutions we regulate are aware of and understand the risks that they run, including risks from climate.
And that they're prepared, and learning how to, as would be the point of a pilot, learning how to mitigate those risks over time. So what criteria will you use to evaluate whether or not you would run the exercise again and/or share more broadly the results of that exercise?
I think we did publish, well, most of the results of that exercise. So I don't know what to say about that. We're looking at it and we're asking ourselves, what did we learn? What do we need to learn next time? So I'm not exactly sure what factors we'll be looking at, but we'll be doing a careful assessment of what more we need to do.
Thanks. Thank you, Mr. Chairman.
Senator Hagerty is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome. Chairman, last week in Portugal, you said that you wanted to be, quote, more confident that inflation is moving sustainably down before you begin to cut rates. You also said in your testimony that you need greater confidence and more good data before lowering rates. Can you give us any color as to what it is you're looking for in the data and how long it might take us to get there?
We need just to see more good inflation data. That's all. We had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so, where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that the confidence rises. I'm not going to tell.
Are we weeks away, months away?
Yeah, I mean, I'm going to try to avoid sending any really specific signals about time today because it's going to depend on the data. It also matters what's going on in the labor market, though. We've also said that if the labor market weakens unexpectedly, that could be a case for loosening policy as well. Really, we're weighing both those factors.
Here's one of my concerns. Yeah, I'm sure you probably share it, but we're coming off of a 40-year high in inflation. We've seen the rate of inflation coming down, but we haven't gotten to the 2% target. And my concern, for lack of a better term, is whether or not this might be transitory in terms of the data that we're seeing right now.
That's exactly why we're approaching this question carefully.
I thought that might be your answer. Thank you, Mr. Chairman. Can we shift now to the issuance of Treasury debt? The Fed is the largest holder of Treasury debt. In February, you and I talked about the pressures that our fiscal deficit is exerting on interest rates, which by extension makes your job more difficult. I'd like to talk this time about how Treasury issuance is impacting our economy and our monetary policy. First, just a basic question. If Treasury issuance were to shift drastically, either to the long end or the short end of the curve, would that affect interest rates? Or maybe more simply, do changes in supply across maturities impact interest rates on the yield curve?
I mean, I think in theory they can.
Yeah, I agree. As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election. And it's shocking how little attention this is getting. Any manipulation of debt management of this nature stimulates inflationary pressures and increases taxpayer burden because it's higher cost to issue these bills. So given that Treasury is issuing an excess of short-term debt, which pulls down longer-term rates, isn't it working at cross purposes with your monetary policy goals of taming inflation?
So we take Treasury's debt management decisions. We don't comment on them. We just do our job.
No, I'm not asking for a comment on their decision, but just as a simple mathematical truth. If they're pulling down demand on the long end of the curve, doesn't that
I wouldn't say that has important inflation implications, no.
It just feels to me the same way that the Biden administration drains the Strategic Petroleum Reserve, that undermines our ability to respond to energy shocks. When the Treasury manages its debt in this manner, it constrains our ability to respond to future economic shocks. And that opens our nation up to very real risk, whether it be amplifying the effects of the Fed's balance sheet reduction, flooding the supply of one of the most important short-term debt instruments. The risks seem to me to be mounting for Treasury market disruption. I'd like to know what your thoughts are, Mr. Chairman, about how the Fed will navigate this and whether you've had discussions with the Treasury about this growing dangerous dynamic.
No, we don't have a seat at the table on Treasury debt management. Treasury makes those decisions, and they don't have a seat at our table on monetary policy.
I just think the risk is very obvious here, though, where we're headed with this type of portfolio
management.
management.
Honestly, it's completely out of bounds for me to comment on Treasury debt management. in any way?
I think you've been dealt a very difficult hand here, Mr. Chair. The Biden administration's policies aimed to gin up the economy ahead of the election. These efforts directly undermine your policy goals at the Fed. That includes excessive issuance of short-term debt. Think about it, Freddie Mac's backstop of second mortgages, unlawful student debt loan cancellations, the draining of the Strategic Petroleum Reserve to suppress fuel prices, and President Biden's own jawboning of the FOMC to lower rates. As you know, the Federal Reserve was structured to shield monetary policy from political influence, and that independence has given the Fed unique credibility in executing its mission. If the FOMC were influenced in any way by political calculation rather than economic data, it would severely damage the Fed's credibility as an independent institution, it would increase uncertainty in our markets, and it would jeopardize the dollar status as the global reserve currency. Thank you, Mr. Chair.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. When the CEOs of giant banks can boost their bonuses by getting the banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 956 told financial regulators, solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words, you trusted the banks to write their own rules. So let's see if they actually have. One thing the proposal would do is require big banks to delay bonuses for a broad group of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking could endanger the bank?
I don't know specifically. My guess is all of them. Since the financial crisis.
You're the regulator who said trust the banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, it's a very, very specific, narrow question you're asking about.
Because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, because we've looked at their statements on this. Another thing the proposed rule would do is require the banks to consider flat-out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right, pursuant to the guidance that we issued in 2010, which is quite detailed.
And you have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is, out of 10,
it was covered
0.
by the 2010 guidance,
No,
actually.
you said in 2018 that they would put these in place.
I said they would have in place.
No, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in finalizing a rule implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is 0. Dodd-Frank was passed 14 years ago, there are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell, in his infinite wisdom, should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy, so write the rules to rein them in. Finally, the other financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks, you work for the American people. I urge you to do your job. Thank you, Mr. Chairman.
Senator Vance from Ohio is recognized.
Thank you, Mr. Chairman, and thanks to Chair Powell for being here. I appreciate you coming by our office last week to discuss some of these issues. I wanted to ask something I imagine most of my colleagues are not asking, which is the relationship between immigration, particularly extremely high illegal immigration levels under the Biden administration, and the persistence of the inflation problem. And I recognize this is not your policy focus, but you are the Federal Reserve Chairman, so I just want to get your views on this. And in particular, I want to read you a quote from Mickey Bowman, who's one of your governors. And this says, in a quote, "There's a risk that increased immigration and continued labor market tightness could lead to persistently high core services inflation. Given the current low inventory of affordable housing, the inflow of new immigrants in some geographic areas could result in upward pressure on rents as additional housing supply may take time to materialize. With labor markets remaining tight, wage growth has been elevated at around or above 4%, still higher than the pace consistent with our 2% inflation goal, given trend productivity growth." The Bank of England, I believe, produced a recent report on this issue in the United Kingdom, obviously a different economy in a different country. But what do you see as the relationship, in particular, given that housing is such a big driver of the inflation that we've seen over the last few years? As Senator Hagerty said, the highest in 40 years. What role do you see illegal immigration playing in driving up housing costs, which, of course, is a main driver of inflation for American citizens?
Let me quickly start by echoing your first comment, which is we don't comment on immigration policy, but we do comment on inflation. So I would say this. Many people came into the country over the last couple of years, many of them through asylum requests, and went to work. Labor supply increased a great deal. It's not, there's no clear answer, but my sense is that in the long run, immigration is kind of neutral on inflation. In the short run, it may actually have helped because the labor market got looser because there were more people. But to you're talking about housing specifically. There will be, I'm sure there are places in the country where new people coming into the country, I'm sure you can find places and they exist where that will have contributed to an already tight housing market. But overall, in terms of aggregate inflation, I wouldn't say it's a driver one way or the other.
So I want to follow up on that thread, but just on that topic of particular areas that have been affected. Chairman Brown, I'd like to ask unanimous consent to submit a letter for the record from the city of Springfield in our state, the southwestern part of our state, which I think highlights a very real example of this particular concern, straight from the horse's mouth itself. Now, this letter, I want to quote from it. "Springfield has seen a surge in population through immigration that has significantly impacted our ability as a community to produce enough housing opportunities for all. Springfield's Haitian population has increased 15 to 20,000 over the last 4 years in a community of under 60,000 previous residents, putting a significant strain on our resources and ability to provide ample housing for all of our residents." And end quote there. And Mike.
Without objection, so.
Thank you. In my conversations with folks in Springfield, it's not just housing. They're trying to build 5,000 new housing units, which is a very Herculean task in a town of about 55,000 people. But it's also hospital services, it's school services, there are a whole host of ways in which this immigration problem, I think, is having very real human consequences. But I want to go back to just one other question, Chair Powell, on this immigration and labor supply question. So One of the euphemistic ways in which economists, I think, sometimes talk about labor supply and immigration is they'll say something to the effect of, well, an increase in labor supply has put downward pressure on labor prices. And what they're effectively saying is that increased immigration has put downward pressure on the wages of American workers. I wonder, when you hear sort of your colleagues and other economists outside of the Fed talk about the influx of immigration and the fact that it, I think, admittedly has put downward pressure on wages. Okay, so there obviously that has put some downward pressure on inflation, but it also puts downward pressure on the wages that people earn to pay for their families. Why do we see that as a good thing? Or maybe that's wrong. Maybe the premise is fundamentally incorrect. But why do so many economists treat an influx of new labor as a good thing? If labor is constrained, labor supply is constrained, doesn't that lead to rising wages for American workers?
So I'm certainly not trying to put a value judgment on it. I will say, though, this is all happening over the last couple of years in a context of an extremely tight labor market, now a little bit less tight, significantly less tight, but you've got a worker shortage, you've got businesses who have jobs that are open, you have, more than one job opening for every unemployed person. So you've got a very tight labor market, and it's addressing that, and we're having wage increases are still very high, but they're coming down to a more sustainable level.
Fair. And Mr. Chair, I know I'm over time. Could I just one more question on this? Thank you. I understand your point, Chair Powell, and again, I'm not ascribing value judgments to you, but if we say we have a really tight labor market, and we say that there are more than one job openings per worker, there are two ways you could plausibly solve that, probably more than that, but two obvious ways you could plausibly solve that. One is through a new influx of workers via the immigration system. Another way is by raising wages and bringing some of the workers that are on the sidelines. I'm thinking specifically of the 7 million prime age men that have dropped out of the labor force. Like, why isn't that more the focus of policymakers rather than, you see a labor shortage, rather than bringing in a large number of new immigrants, why not try to boost wages in a way that brings some of those workers off the sidelines? That seems to be a much better focus from my perspective.
Certainly, that's a very constructive focus. I would agree. It's not, I don't think it has to be one or the other.
Thank you, Mr. Chairman.
Senator Van Hollen from Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you. And let me first applaud you and your team at the Fed for, at least so far, being on track to bring down inflation without, so far, triggering a surge, big uptick in unemployment. But you know very well that that's a risk if the Fed does not act with full awareness of that danger. When you were here in March, you said that you were, quote, well aware, unquote, of the risk to unemployment of waiting too long to cut rates and, quote, very conscious of avoiding it, unquote. Since then, we have seen a slowing in the economy and a rise in unemployment. I'm just reading something today, an analysis with Diane Swank, KPMG's chief economist, who summed it up by saying, quote, the ice is thinning, red flags are emerging for the U.S. economy, unquote. The engine of the economy, the labor market, is cooling faster than previously known. The unemployment rate is above 4% for the first time since 2021. It is taking workers longer to find jobs. Economic activity in the service sector, which is responsible for 2/3 of economic growth, slowed in June. So my question, Mr. Chairman, is how do you take all of these factors into account? Do you share my concern that as of today, there is a real risk of an increase in unemployment larger than is currently on your radar screen?
Yeah, I mean, absolutely. I do, even more so than in March when we were here, see that. So we've seen, and I think the latest data show that labor market conditions have now cooled considerably from where they were 2 years ago. And I wouldn't have said that until the last couple of readings. And I would say also that for a long time, the risks were more that we would fail to hit our inflation target. I think the risks as to the two statutory targets we have price stability and maximum employment. I think those are coming much more into balance. My colleagues and I are looking at that, and we fully understand that we have to manage this process of administering the federal funds rate and deciding what to do with it in a way that manages both of those risks. And, the two mandates are equal under the law. And so, yes, we do get that.
Well, I appreciate that, and I appreciate the fact that you've seen that that calculation change since you were last here, because I think the data indicates that we are at risk now of not acting soon enough to curb the increase in unemployment, and that if we allow that to go too long, we may see a real uptick there. And so I'm pleased that that is very, very much on your radar screen, and hope that that will be a really deciding factor as you and your other Fed colleagues determine what to do with respect to interest rates. And as has been said in the housing sector, we are seeing the continuing drag created by high interest rates. So that has been I think all of our colleagues, as you probably heard today, are really hearing from our constituents, understandably, about the very high housing prices. And it's slowed investment in other sectors like manufacturing as well. In my final minute, I would like to turn to the question that Senator Warren asked, because I asked your colleague, Vice Chair Barr, about exactly this question of implementing Section 956 of Dodd-Frank when he was before the committee just a short time ago, May 16th of this year. And I asked him about why the Fed had not moved forward along with other agencies with respect to implementing what the law is and what the law has been for 10 years. NCUA has signaled their intent to propose a rule. The SEC has indicated that they're moving forward. I said to Vice Chair Barr that I've not seen any notice of proposed rule from the Fed, and can I get a commitment that the Fed will quickly begin to process implementing this law by issuing a notice of proposed rule? His answer was, and I'm quoting, "In discussions with my colleagues, it became apparent that at the board, we believe we need to conduct some further analysis before deciding what steps to take. We are committed to following the law, to implementing Section 956, but we have further work to do." Count me among those who are very frustrated that we're now 10 years after this law was passed. Vice Chair Barr committed to following the law. I'm sure, Mr. Chairman, you would commit to following the law. But why is it that it's taking the Fed so long to move forward with implementation of 956?
So I like to look at the actual language of the statute when and what it says is it calls on the regulators to make determinations about specific incentive compensation practices that cause excessive risk taking. And then, and we haven't done that. We did, that we put in place pretty serious guidance back in 2010 after putting it out for comment. We looked at all these questions. It's been in place for 14 years. We supervise on it. And, so the question I'm asking is, okay, let's go out and look at what the practices are that are happening now, not that are happening before the global financial crisis when it was obvious that things needed to be changed. And we put the guidance in place. It seems to have largely worked, certainly as it relates to the large firms. And then let's design something that is designed to the residual risk as opposed to just taking something off the shelf from 15 years ago and doing that. So and we're working on that at the Fed now. And again, the statute requires us to prescribe regulations or guidelines to prohibit those things, and I want to do that. In a sense, we have done it.
Just very briefly, and is it your testimony that the Fed has already met the requirements of? Okay,
no.
Just want to make that clear, and we do look forward to the Fed moving forward. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being with us today. My colleague from Maryland actually just touched on something, but as I was listening to the exchange from my colleague from Massachusetts and her closing remarks, particularly about Dodd-Frank and 956, there was also a comment at the end where she mentioned you working for giant banks versus the American people. Now, I have a long list of questions I want to talk to you about, but I did want to get you to respond to that.
Yeah, that's completely untrue. You know, the things that we're doing are consistent with our international obligations, and they're meant to be the best thing for the American economy, and that's really our only consideration. We have policy differences across various things, but you know, we're all trying to achieve the best results we can for the people that we serve.
Absolutely, thank you. Chair Powell, I have repeatedly talked about my concern with long-term debt proposal, and just think that it has not been well thought through. First, I have concerns that it blatantly undermines the tailoring requirement, and on that note, do you believe that 2155 will be applicable to the long-term debt requirement?
I think it applies to everything.
Absolutely.
And on the long-term debt requirement, you know, we have voluminous comments that we're looking at carefully and thinking through the process of what to do about them.
No, I appreciate that because I do believe that currently it lacks a real cost-benefit analysis, and I think it really does need serious reconsideration. And additionally, when you take a look at it and its overlapping nature with Basel III, it seems inappropriate that we would move forward with a new long-term debt proposal, finalizing that rule when we don't even really understand what Basel III is going to mean for capital requirements for banks and obviously financial institutions. So my question for you is just that. Would it be inappropriate to move forward with the long-term debt proposal, finalizing that rule prior to Basel III being finalized as well?
I don't know that I would give you, I can't give you a clear answer on that. It will depend. I mean, Basel III won't be finalized for some time, but that's not to say we wouldn't reach a place where people understand and accept and support what it is that we're doing. And I think at that point, we could certainly move forward with other rules.
I heard you mention to one of my other colleagues that probably by the time this all took place, it would be the beginning of next year. I would just say my concern, the Fed has said that the long-term debt rule will directly be impacted by the final Basel product. And so, you know, why would it be inappropriate or appropriate to move forward with that before banks can fully understand what they're facing from Basel? So I would just ask that y'all are thoughtful about that. These are a lot of things that people are dealing with and trying to really understand the implications of. And I think we have seen consistently that people are not taking a look at the cumulative impact of these things and not really taking a look at the trickle-down effect. And on that, on Basel, when you testified in March, you said the Fed was aware and fully considering the potential impacts of a proposal on our commodities markets. And I do want to talk about that. The commodities market, our agriculture industry, is 1 in 5 jobs in the state of Alabama. It's 20% of our economy. I am a big believer food security is national security. And the proposal would increase hedging costs by 80%, meaning banks would be far less likely or inclined to offer clearing services. So this could have a detrimental effect to our agriculture community and increase other costs providing food and fiber for our nation. When you look at inputs such as feed, seed, fertilizer prices, those have skyrocketed, and prices have ended up just getting passed down to the consumer. I mean, grocery prices are up 21% since January. So do you believe that the revised Basel proposal will alleviate these concerns that our farmers and our ag community have had about Basel III? And has the Fed done anything specifically to take a look at this? And if not, will you commit to doing so?
So I don't want to get into the specific changes that we're going to make. I'll just say that we're very well aware of and very focused on that particular set of changes and, you know, paying close attention to the issues you've raised.
I appreciate that, and I also hope that the Fed when you craft these types of regulation, you really consider the relationship between the economic impact and the ability of community banks to serve their communities as well. I have heard you mention that to another one of my colleagues, so I know that you're committed to doing that, but that is incredibly important to Alabamians and our main streets all across the state. In my last few seconds, I want to touch on one more topic. So finding solutions to expanding affordable childcare is a top priority of mine, and it is something something that I know a number of my colleagues on the other side of the aisle share an interest in and believe is an important issue as well. So Chair Powell, do you believe that increasing access to affordable childcare would positively impact labor participation in our country?
I do believe that.
Thank you.
Stowe of Nevada is recognized.
Thank you. Excuse me, Chairman Powell, thank you for joining us. And I always appreciate visiting with you in my office as well, and your comments. Let me start by a comment you made in the opening. Over the past 2 years, you said the economy has made considerable progress toward the Federal Reserve's 2% inflation goal. Labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. And what we know is that since Biden came into office, the United States has added over 15 million jobs. Under President Biden, we had 41 consecutive months of job growth, and you've just said it again here today, that wages are up as well. Average U.S. wages and salaries grew by nearly, 16,700 between January 2021 and April 2024. So would you agree with the statement by our ranking member earlier today that the U.S. has the greatest economy on the planet?
I certainly would.
Let me ask you this. Jumping around, and there's been talks today about the Fed's independence and how important the Fed's independence is. The Wall Street Journal recently reported former Trump administration officials drafted policy options to weaken the independence of the Federal Reserve if President Trump were to be elected in November. Allegedly, former administration officials discussed policy options to erode the Fed's independence to make it easier for a president to impact interest rate decisions or fire the Fed chair at will. Chairman Powell, how important is it that the Fed has independence to provide economic stability and anchor our inflation expectations?
So I think it's actually essential. It's literally essential. And the good news is I think that's pretty broadly understood, and particularly on Capitol Hill, on both sides of the aisle. I believe that people do understand that we need to do our work in a way that's outside the political process to the maximum extent possible. Of course, we need to be accountable and tremendously transparent. If you look at the box in the Monetary Policy Report on central bank independence, it's really a box about transparency. That's the other side. So I think it's really important. I think it's an institutional arrangement that has served the public well. And and I do believe that there's pretty wide support for it.
And you just said that it has been intentional and institutional arrangement over the years for this very reason, correct?
Yes, this is a choice that we make, and I think it's countries around the world, advanced economies, have all made this choice effectively, and the results are clear that you now have independent central banks, and you have better anchored inflation expectations, and you have better performance on inflation and better performance in the economy generally, which isn't to say there won't be shocks and crises and that kind of thing.
And then let me touch on a subject that one of my colleagues just talked about, because I was going to ask about this, which is our immigration. In Nevada, immigrants are extremely important for our economy. They're essential workers, doctors, nurses, and teachers in my community. Can you, without getting into other ancillary issues that don't impact what you do, can you talk about and elaborate on how immigration affects the employment rate and why you look at it and for what reason you look at the immigration issue?
So we don't, as you, just to make the point that you made, we don't take a position, we don't comment on immigration policy. We have no responsibility for it. It's not our job. But, so we just look at the numbers and we sort of try to assess the economic consequences of immigration. And over the last 2 years, 2 years ago, we had an economy where we really had a labor shortage. And what's happened is we've had a wave of immigration, and many of those people have gone to work and gone to work legally through the asylum process. Not all of them. There's also a group that has not been legally processed, but many of this latest group have been have sought asylum and then gone through the process of getting a work permit. So what that means is that employers wanted workers, and there were more job openings than there were people actively seeking work or working, And so now you have a new supply of workers, and they've filled those jobs. So we have a bigger economy, but it's not a tighter economy because labor supply has increased the economic capacity. That's just the arithmetic. That's not saying it's a good thing or a bad thing. There are
And
other
so-
policy choices that could be made, and they're not for us to make.
When you say greater economy.
A larger economy.
In other words, it has improved the growth of our economy.
All right, the economy grew 3-point-something percent, 3.4%, I believe, last year. And some part of that was that, as Congressional Budget Office analysis showed, and to many surprise, there had been a really significant uncounted group of workers coming into the country who had gone to work. And that's part of the story of how the economy managed to grow that much while inflation was coming down pretty sharply. Inflation came down 2 full percentage points during 2023 while the economy was growing at 3.4%. So, and while these people were coming in. So that is part of the explanation for why we had such an interesting and pretty good year in 2023.
Thank you.
Senator Kramer of North Dakota is recognized.
Hi, Mr. Chairman. Thank you, Chairman. As always, all of my prep goes out the window with the last question. So on the legal immigration workforce front, and I know this isn't your bailiwick, but the issue of workforce is important to the economy. I would submit to my colleagues, beyond even the people who come here seeking asylum suddenly being available for the workforce, we have 1 million plus people who we welcome in legally every year, the vast majority of whom don't come in with a job or even a skill set. And we have so much work to do, colleagues, on the legal immigration front to create a connection between economic demands for workers and the skill set and education that our immigrants bring to us. So most every other country requires some sort of skill set useful in the economy. We don't do much of that. So that's just my speech for the moment. I know, Mr. Chairman, you've gotten already lots of very specific questions, and I've heard a couple of them on Basel III. So I'm just going to make an illustration, and you can comment on it if you'd like. But there's a large generation and transmission utility in North Dakota, rural electric cooperative, Basin Electric, very large G&T, members all over the upper Midwest. And they recently testified in front of the CFTC on Basel III, and they expressed a concern about how operations would be impacted if lending was curtailed or limited in any way. And they gave a real-world example, and I want to just give you that example. Now, remember, this is an electricity supply that we're talking about. It's critical it remains reliable. It's critical that it remains affordable. And part of an electric cooperative's risk management program, of course, is how it buys the fuel that generates the electricity, in this case, natural gas. They may buy natural gas in advance at a fixed price, realizing natural gas is one of those commodities that goes up and down in pretty big swings at times. But they can hedge by buying it at a fixed price for a power plant. And it protects the cooperative financially, since electricity prices, again, follow those spot prices generally. So if spot prices spike, so do electricity prices. However, with a natural gas hedge, the cooperative can generate electricity at a lower fixed fuel cost, protecting itself and its consumers from high prices. It's an upfront cost on the balance sheet between the cooperative and its bank, but it protects the reliability and affordable supply of electricity. I give you that very specific example, not even to mention that the cooperative model itself has some unique qualities about it. If you would like to comment on it, you've already stated that there are going to have to be changes. I just throw that into your box of things to think about, and you're welcome to comment if you'd like.
I'll just say we're well aware of that issue, and I appreciate you bringing it up.
Thank you, Mr. Chairman. With that, then, I'm just going to speak to this independence issue. I think that the senators that have questioned you on it are correct. I share that concern, as you know, that the independence of the Fed is essential. I have resisted moves within my own party to change it, but those moves are very narrow and not very, I don't think, very realistic. And I appreciate you pointing out that from what you can tell, at least on Capitol Hill, we're all pretty much united on that front. Perception does matter. It matters a great deal. And you and I have had discussions over the years on, you were very You admonished us strongly as Congress to spend what we needed to spend to get through the pandemic and to maintain the economy. I think you were right to do that. You were just as aggressive in not responding to calls to rein it in a little bit when Democrats brought the Inflation Reduction Act and the American Rescue Plan to the forefront, and I think really basically hijacked the economy and put fuel on inflation. But perception matters, and so I would just submit to you, and you haven't said you're going to do this. I don't have any reason to believe you'll do this, but any move to lower interest rates or move interest rates either direction before November 5th could certainly be a bad perception, even if there's a strong push to do that. I know you understand that, but I just want you to know that as long as you remain independent, I'll be on your side. I think neutral is a good place to be. And by the way, you have one of those jobs where being boring is one of the most noble things you can be. So great job. Thank
We
you.
do our
Thank you,
best.
Mr.
Senator Kramer. Senator Warnock is recognized, who is decidedly not boring.
Thank you very much, Mr. Chairman. The latest monetary policy report shows inflation in housing costs is gradually easing. That's good news. But many Georgians still feel the sting of unaffordable homes and mortgages. And one reason for this, you and I have discussed this, is that we aren't building enough houses. 2022 study published in the Journal of Economic Geography found that for every 10% increase in the housing stock, rents decreased by 1%. We've discussed this issue, particularly the effects of housing supply on housing costs. And we agreed that while the Federal Reserve does not control housing supply, it can help create the environment that encourages the construction of new housing, particularly affordable housing. Chair Powell, how has the Fed been working to foster an environment that encourages home construction, and what, in your view, are the challenges that remain?
So, I mean, in the long run, the absolute best thing we can do for the housing market and for the economy is to sustainably bring inflation back down so that people aren't talking about it anymore. And it's just assumed by everybody in their daily lives that inflation will be around 2%, so we don't need to talk about it, which is where we were for a long time. We want to get back to that. Interest rates can come down then, and the housing market can return to the state it was in before the pandemic, which was to say really tight. We don't have enough housing, and that's not really a monetary policy issue. In the short term, though, I would say tight monetary policy weighs on the housing market. The policy works through interest-sensitive spending, and housing is definitely at the top of the list of interest-sensitive spending. So we understand that we're suppressing. Not suppressing, but our higher interest rates, have led to lower housing starts and lower activity in the housing market. But we're doing that to get back to 2% inflation for the whole economy, so that the housing market can be on a better foundation.
Well, yeah, and related to that, when you have these high interest rates, of course, you see across the country, but particularly in a state like Georgia, these institutional investors who are coming into the space, and they're buying houses in all cash, boxing out first-generation home buyers. And of course, the conditions for them doing that improve to their favor with higher interest rates. Would you agree with that assessment?
I know some of that's happening. I don't know that higher interest rates make it. I mean, some of they're working with.
Well, you got higher interest rates and you got institutional buyers who can purchase it all cash. Doesn't that further?
But they have to borrow the money at higher interest rates. I'm just saying higher interest rates doesn't make their investment any cheaper. And notwithstanding, I understand it's a sensitive issue, and in most markets, it's still a pretty small portion of the outstanding housing stock. But it's not an issue. It's not an issue for us. They're a legal buyer of housing. Our job is really the whole economy. It's more of a question for legislatures.
So how can the Fed better deploy its monetary tools to ensure that we are meeting key inflation objectives like housing affordability?
I think the best thing we can do is to is kind of what we think we've been doing, which is to move carefully as we think about loosening policy and make sure that once that we do that, when we've got greater confidence that inflation is moving sustainably down toward 2%. We're also keeping a close eye on the labor market, and if we see unexpected weakening there, then we could respond to that too. But that's really the best thing we can do for the whole economy and very specifically for the housing market too.
You well point out that you're limited in terms of your influence there, and there is a role for Congress to be sure, which is one of the reasons I wanted to be on this committee to introduce a down payment toward Equity Act with my colleague Senator Butler. This bill would help first-generation home buyers compete with Wall Street institutional investors by helping with down payment costs, closing costs, and costs to reduce interest rates. I look forward to continuing productive conversations with you and looking at how we can make housing more affordable for all of Americans. I'm running out of time here, but one of the other concerns that I maintain is with respect to reducing the racial wealth gap. Is this issue around home appraisals. And the Fed is part of the interagency task force on property appraisal and valuation equity. What expertise and perspective has the Fed brought to this task force? How are you responding to this issue of home appraisals?
So, as you know, we've been an active participant in that task force, and we bring all of the expertise we have in the housing market, as well as regulatory, supervisory, and economic expertise generally, as we look at that. And I'll also say that our strongly held view is that discrimination has no place in the banking system, and that includes appraisals and other valuations.
I agree with that, and quickly, I was glad to see that CFPB and other agencies recently finalized a rule that creates strong anti-discrimination standards for automated home evaluations. The Fed has not yet approved this rule. Why not, and does the Fed plan to do so?
Sorry, why do we?
You've not yet approved the rule that was made, that was suggested by the CFPB. They finalized the rule.
But do we? Sorry. I'm not aware that it's a rule that we have to finalize too. Is that the case?
That is my understanding.
Let me follow up with you on that. I'm not aware of that.
Okay. Thank you.
Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here today. Certainly, it's not lost on anybody here. Election season's in full swing. And so from now until Election Day, my Democratic colleagues in Congress, as well as the Biden-Harris administration, will waste no time attempting to sell a fairy tale to the American people that financially and economically they are better off now than they were almost 4 years ago. When President Biden took office, inflation was at 1.4%. His failed policies drove us to the highest inflation we've seen in 40 years. I can tell you the folks back home in Montana aren't fooled, because in every part of their lives, inflation is not some kind of hypothetical. They see the everyday impacts of the decades-high inflation brought on by the policies of the Biden administration and facilitated by congressional Democrats. The cost of most goods and services across the economy are more expensive than they were in 2020, and that is a fact that no amount of political spin or mental gymnastics can make go away. Here's just a couple of examples. Breakfast cereal. Prices have increased 28% since January of 2020. Gas prices increased 36% from a national average of $2.63 a gallon to $3.58 per gallon. Egg prices have jumped $3 per dozen in 2024, double the cost of $1.45 in February of 2020. And this dishonesty doesn't stop with inflation. On the labor market, while President Biden and Senate Democrats are celebrating a victory lap in light of the recent jobs report showing a 206,000 new jobs last month, they're willfully ignoring the fact that more than a third of these job gains came from the government sector. Mr. Chairman, I commend you for the job you have done thus far in trying to rein in inflation. I encourage you to continue the fight despite the political pressures you may face. I'm also encouraged by the comments you made earlier this month about the dire need for Washington to address its fiscal imbalance. I couldn't agree more. I've said many times and continue to believe that Washington's culture of reckless spending, of excessive borrowing, is leading us down a very dangerous path by leaving future generations with mountains of debt. And I'm happy to hear you agree with that assessment. Mr. Chairman, given that it's an election year, you're undoubtedly facing immense political pressure to lower rates. Thus far, you've done an admirable job in using the tools at your disposal to fight inflation, and I urge you to continue to be led by data and not calendars or political influence. You said as recently as last week that while things are trending in the right direction, you would need to see further evidence before cutting rates. So here's my question, Mr. Chairman. What specifically are you looking at and looking for as we head into the next FOMC meeting, and how do you factor in this recent labor data, and certainly the significant part of that being government jobs?
So we're looking for two things, really. One is just more good inflation data. And we had quite a lot of good inflation data the last 7 months of last year. Then we had kind of a bump in inflation in the first quarter. And now we've had one good and one very good inflation reading, and we need more good data so that we can be confident that what we're seeing is really, that's where inflation's going, that it's going back down toward 2%. We don't need to see it at 2%. Right now we're at 2.6%. So that's on inflation. On the labor market, to your question, we've seen that the labor market has cooled really significantly across so many measures, and a number of people here today have pointed them out, and the unemployment rate has moved up. You see a labor market that is now pretty much in balance, pretty much where it was in 2019. It's not a source of broad inflationary pressures for the economy now, but it's still a strong labor market. 4.1% unemployment is a very good and historically low unemployment rate. So we have a mandate to support maximum employment, and we also are paying close attention. And if we see that the labor market were weakening unexpectedly, which is to say, more than what we've seen in a material way, unexpectedly, then we could also respond to that, because we have a dual mandate, and we now see the two mandates as more in balance than they were a year ago. Really, the focus had to be and was on inflation. Now we need to be focusing on both goals.
Chairman, thank you. I want to get one question on Basel III, and then we will. In March, this committee agreed that it was seriously flawed and needed to be completely rewritten. I was encouraged to see reports last month that the Federal Reserve had provided other financial regulations with possible changes to the proposal. My question is, I continue to believe the proposal should be scrapped altogether, but could you share what changes you're planning to make and the status of the ongoing development of the updated proposal?
So we've had extensive discussions led by Vice Chair for Supervision Barr with the FDIC and the OCC. We've made a lot of progress in getting close to an agreement on a set of proposed changes. The work that remains is to agree on a process forward. How are we going to move forward? It is our view institutionally that we need to put the changes out for comment for some period of time so that the public, all members of the public who want to comment, can see them again and comment on them again, and see them in the context of the quantitative impact survey that we did, and that's the right way to proceed. That's how we would ordinarily proceed, and we don't see why we would deviate from that. And this is the conversation we're now having with the leadership of the FDIC and the OCC, and my hope is that we'll be able to come together around a way to proceed forward, very soon. I'd hope we would have done so by now, but I believe we will do so fairly soon.
Thank you for joining us today, Chair Powell. I look forward to working with you to strengthen this economy. For senators who wish to submit questions for the hearing record, they're due 1 week from today, July 16th. To Chair Powell, please submit your responses to questions for the record 45 days, no more than 45 days from the day you receive them. Thank you for your testimony. The committee's adjourned.